Welcome viewers. In this session, we are going to cover weighted average cost of capital, which is called WACC. We will use the December 2014 ACCA F9 Financial Management question number 5. Let's go to the required. Required A, calculate the market value weighted average cost of capital and the book value weighted average cost of capital of Tinep Co. and comment briefly on any difference between the two values, 9 marks. B, discuss the factors to be considered by Tinep Co. in choosing to raise funds via a rights issue. In this session, we are not going to cover part B, but we'll only concentrate on part A, the calculation of the weighted average cost of capital. Now, let's go to the scenario. Tinep Co. is planning to raise funds for an expansion of existing business activities, and in preparation for this, the company has decided to calculate its weighted average cost of capital. Tinep Co. has the following capital structure: equity, ordinary shares 200, reserves 650, non-current liabilities, loan notes 200. The ordinary shares of Tinep Co. have a nominal value of 50 cents per share and are currently trading on the stock market on an ex-dividend basis at $5.85 per share. Tinep Co. has an equity beta of 1,15. The loan notes have a nominal value of $100 and are currently trading on the stock market on an ex-interest basis at $103.50 per loan note. The interest on the loan note is 6% per year before tax, and they will be redeemed in 6 years' time at a 6% premium to their nominal value. The risk-free rate of return is 4% per year, and the equity risk premium is 6% per year. Tinep Co. pays corporation tax at an annual rate of 25% per year. Required, calculate the market value weighted average cost of capital and the book value weighted average cost of capital of Tinep Co. and comment briefly on any difference between the two values, 9 marks. Now, before we calculate the weighted average cost of capital, there are a few formulas that we need to know. We need to know how to calculate the cost of equity. In this instance, we will use the capital asset pricing model known as CAPM. The formula is risk-free rate plus beta bracket risk on the market minus risk-free rate. The RM minus RF is sometimes called the equity risk premium. We will also need the formula to calculate the cost of debt or the cost of the loan, which is equivalent to the IRR formula. And the IRR formula is saying the lower discount rate plus the NPV at the lower discount rate divided by the NPV at the lower discount rate minus the NPV at the higher discount rate, all multiplied by the higher rate minus the lower rate. Now let's do the calculations now. We have to be methodical in how we approach the calculation of WACC. The recommended approach is to first calculate the costs of capital. Let's do that. Tinep Co. cost of capital. We will start with the equity. The formula for equity we have just said there, it's RF plus beta RM minus RF. Then this is equal to, the risk-free rate of return is 4%. So we'll say 4 plus beta, we are given beta here is 1,15. Bracket RM minus RF. RM minus RF is the equity risk premium, which is 6%. So we'll say 6 here. We get our percentage as 10.9%. Then now we have to calculate the cost of loan notes. We said the cost of loan notes, we will use the IRR formula, whereby we have got to have the lower rate, the lower discount rate, the NPV at the lower discount rate, the NPV at the lower discount rate, and the NPV at the higher discount rate. So to do this, we have to have a 7-column table. The 7-column table will have the year, we have the details, we have the cash flow, we will have the discount factor. I have chosen to discount at 4%. We have the present value. Again, another discount factor. I have chosen 5%. We have the present values. This table, most people like to choose the discount factors between 5, discount factors of 5 and 10, or also the discount factors of 10 and 20. Any discount factor that you choose will be acceptable. It will give an acceptable answer as long as you are following these steps. Now we have the year 0. We will have years 1, 2, 6. We have year 6. Then under details, we will have the market value of the loan. We will have the interest. We will have the redemption value. Now the interest, take note of the interest. The interest on the loan is 6% per year before tax. Every time we want the interest after tax. So 6% of the nominal of 100, it's $6. Then we say $6 multiplied by 1 minus the tax rate. The tax rate, we are given the tax rate as 25%. We get $4.50. Then the redemption value. We are told here the interest rate on the loan is 6% per year, and they will be redeemed in 6 years' time at a 6% premium to their nominal value. So we'll say the nominal value is $100 multiplied by 1.06, because they will be redeemed at 6%. So we get 106. Then the market value as at today, X interest basis is 103. So we put this as a negative 103.5. Let's put the comma there. Then we have to find the discount factors at 4% and at 5%. Year 0, it's always 1. Year 0, it's always 1. Then now we have to find the discount factor for years 1 to 6. This is an annuity. So we have to go to annuity tables. Let's go to the annuity tables. These are our annuity tables as they are written on top there, annuity tables. Then 4% for 6 years is 5,242. So it's 5,242. The annuity 5% for 6 years is 5,076. 5.076. Then redemption value in year 6. Now we have to go to our present value tables. 4% 6 years, 5% 6 years. So 4% 6 years here, 0.790. Let's put enough decimals here. Copy that to here. Then under 5% is 0.746 for 6 years. Then we do the multiplication. We say cash flow multiplied by the discount factor. We get that figure. We drag the formula down. Then we also say here, cash flow multiplied by the discount factor. We drag the formula down. Then we have to have a sum here of the present values. Sum there. We copy that to here, this side. So the present value at the lower interest rate, the lower interest rate is 4% and the higher interest rate is 5%. So this is the NPV at the lower interest rate, and 1 minus 1,58 is the NPV at the higher interest rate. Now we have to apply our IRR formula. We now have to apply our IRR formula here. Our IRR formula, as I said, it's a lower rate, NPV of the lower rate divided by the NPV of the lower rate minus NPV of the higher rate, all multiplied by higher rate minus lower rate. Now let's calculate our IRR, which is the cost of loan notes. Our lower rate, it's 4 plus, open bracket, plus NPV of the lower rate 3,83 divided by bracket 3,83 minus we get a plus 1.58 bracket. Then if we put this to 1 decimal place, we get 4.7%. Now we have calculated our cost of loan note. Is 4.7%. Now we have to go finally to calculate our weighted average cost of capital. We will start with the market value weighted average cost of capital. Market value. Let's display our question. Market value of the market value weighted, the market value WACC, market value WACC. The market value WACC, we have to create a table whereby we will say equity, here we have the book value, nominal value, market value, total market value, we have the cost, we have got the total, then our book value for equity, we have got 200, our loans, the market value, we also have got 200, the nominal value of our shares is 50 cents, the nominal value for our loan is 100, the market value is 5.85 for our equity, the market value for our loan is 1,03.5. Then the total market value now, we will say book value divided by nominal value multiplied by the market value. We get that figure. Then we do the same for the loan notes. Here we will have to sum here. We have to sum here. Then our cost, the cost of equity, we have found it above the 10.9. Our cost of loan or cost of debt is 4.7. Now we have the total there as the product. We say total market value multiplied by the cost. We get that figure. We copy it to the debt. We also copy the total there. Then now, let's find our WACC. Our WACC will be equal to total market value divided by, our WACC will be the total divided by the total market value. So our WACC will be 10.4%. The market value WACC will be 10.4%. Now, let's calculate the book value. The book value WACC. The book value WACC. The book value WACC will be equity and loans. Here we'll be taking the book values from the balance sheet or the statement of financial position, and we'll have the cost, and we'll also have our total there. Now, the book values for equity, it should be ordinary shares plus reserves. So here we will have 850. Then the book value of the loan will be 200. The cost remains the same, 10.9, and for debt 4.7. Then our total will be book value multiplied by the cost. We copy that. Then here we have to sum there. Sum of the book values. We also sum the total. Then we calculate our WACC. Our WACC, as usual, will be the total divided by the total for the book values. Then our WACC to one decimal place will be 9.7 for book values and 10.4 for the market values. I want to stress this point that the book value WACC is not frequently required, but here we are in 2014 it was required. When calculating the book value WACC, we have to use the book values as per the financial statements, and the book value of equity will always be ordinary shares plus all the reserves that will be there. Then when calculating the market value, we don't include reserves as part of equity. So for you to earn these 9 marks, you are supposed to follow this methodical approach, whereby you have to first of all calculate the costs of capital, which is equity, and cost of the loan notes, which is the cost of debt. But the cost of debt has got more marks, as you are required to calculate it using the approximation formula for the IRR, which requires you to use this 7-column table. And also bear in mind that I have chosen the discount rate of 4% and also the discount rate of 5%, but any other 2 discount rates that are chosen, they will be awarded full marks, and the answers will be slightly different, but it will be marked correct. Thank you very much, guys, for listening and stopping by my channel. Do not forget to subscribe and share if you found this video useful. Thank you.